And so what I did here is I took Arthur Hayes's article, his article that he published just a couple days ago entitled Hallelujah. There's a link here to it, by the way. I took his article and I fed it to Claude and asked Claude to, change this a little bit to make it a little bit easier to understand. And then after I was done with that, I turned it into two different versions of an interactive web app or website. So I want to start with the website version first. And then I'd like to talk through this because it seems as though if those tech stocks have found resistance and if Bitcoin is, basically at long-term support, what's the catalyst to push things higher? What is that catalyst? I think it's got to be money printing. Money printer go burr. But when? If that doesn't happen this week or this month, then maybe there's still more room for downside. So I just wanted to be prepared for more downside, but also I want to be positioned for what I think will be a massive run higher because this is structurally bullish. This money printer is structurally bullish. So in the article, Arthur Hayes says the US government needs to borrow $2 trillion every year just to keep running. But who's buying? Who's buying the treasuries? So according to Hayes, after in 2022, Russia invaded Ukraine, Russia had like greater than $100 billion of US treasuries, and they were seized by like Europeans. So, and then the US Treasury system, so that they were seized. So if central banks know that their holdings of US treasuries can at any point be seized, well, then they're probably not going to be buyers at the margin of US treasuries. And instead, they've been buyers of gold. And so that's what we've seen from central banks. They're not big buyers of US treasuries. Instead, they're buying gold. Then Arthur Hayes talks about savers, US savers. Are they buyers at the margin of US treasuries? And the answer is that no, not enough. And then he takes a look at these big banks, the bulge bracket banks. How much are they buying? Well, those bulge bracket banks got hurt badly when Fed Chair Powell, jacked up interest rates beginning in 2022. So all of the treasury securities that these big bulge bracket banks have been holding, they've got massive losses on. And so they're only buying, $300 billion, but the whole, the deficit's 2 trillion. So the banks are not buying enough. So who's financing the government? Well, according to Hayes, it's relative value hedge funds that are running a basis trade where they buy, $1 trillion of treasuries and then immediately, sell the equivalent, futures contract. And then they collect a tiny basis spread. So that's described here in the leverage machine. So these hedge funds that are buying these treasury assets, they're running this trade that requires this daily financing. And when we get down to the bottom of this web app, there are some similarities, I think, between this like daily financing loop and flash loans in DeFi. And so you'll see that at the end of this. So these hedge funds, they don't use their own money. They're running this levered trade where they buy a treasury and then they sell the corresponding treasury future and they earn the tiny spread between the two. And so because that spread is so small, they have to use a ton of leverage. And the way that they do that is through the repo market. So you guys saw on last Friday, the Fed had to step in with $30 billion to shore up some of this plumbing. Well, earlier this week, Tom Lee was explaining that away as window dressing. He was saying that potentially that injection, tightness in this repo market that required that $30 billion injection from the Fed last Friday, that could have been explained away by, some big bank doing some window dressing at the end of the month. That was the way that he explained it away. I really like Tom Lee for his vision. What I dislike is that during periods of stress, he's an uber bull. Like I've never actually heard him express anything other than it's all good, just hold and buy the dip. I've never actually heard him express a bearish opinion ever. And so that's I don't really like that because then you end up missing, all of the, you don't protect yourself on the downside. So let's continue on here. So this is interesting. You know, this repo market. So what happens when cash is not available in the repo market, and who's lending to this market, and what are the different rates at which you can lend to this market? So when things get tight, if you move the slider to the right, then SOFR that starts to trade at or above, and I'm still getting a tight handle on this, but I believe that when cash gets tight in the repo market, SOFR will start to trade above the upper band of the Fed funds rate. And that's when the Fed will step in, and as long as there's collateral pledged, the Fed can print an unlimited amount of dollars to shore up the plumbing here. So as the usage of the facility increases, take a look at so what happens here. So as things this is when the plumbing becomes better, the rate goes down. If things get tight and the rate goes up, well then what we saw on Friday was this right here, SRF active. So we're going to get into that SRF too, but this is what we saw last Friday. Now, what happens when things get even tighter? Well, all of a sudden, money printer go burr. So this is something that I think is worth watching because we saw it blow up last Friday a little bit. And since the government is still shut down, I think this is worth watching. So really interesting here. So this is the Fed's secret weapon, this standing repo facility. So when cash gets tight, and those repo rates spike above the Fed's upper band, that's the Fed funds rate, which right now the upper band sits at 4.25%. Then the hedge funds, those are the guys buying those treasuries to engage in that basis trade. They can't finance themselves cheaply enough, so they stop buying treasuries. And remember, they're the marginal buyer of treasuries. They're the ones actually buying this stuff. So if they stop buying treasuries, then well, that's a problem.